Hello friends, this is Aaron Brown, your friendly real estate agent, guiding you through the minefields of property procurement and real estate investment. Welcome to episode 2, titled Leveraging Real Estate to Build Passive Streams of Income. In this episode, I will explain how to purchase properties and then turn them into wealth-generating rentals. I'd first like to start out with 7 terms. First one is profit, money that is made after paying all expenses. In the real estate rental world, we call this cash flow. The second is interest, money that is paid to a lender in exchange for the lender loaning you money. The third is principal, the money that is borrowed. The fourth is equity. This is value that rests within the house, whether it is derived from the paying back of the principal amount of money initially borrowed for the house, the value captured during the purchase, value created through improvements, or value added through appreciation. The fifth term is appraised value, the assessed value of a piece of property assigned to it by an appraiser. And the last two were from the first episode: asset, something that puts money in your pocket, and liability, something that takes money out of your pocket. Here I'd like to speak to you about the 6 wealth generators derived from rental properties. I will depict it with the aid of 2 graphics. The one on the left is a piggy bank, which represents accumulated wealth that is yours, but that is not immediately available. The second graphic is a fistful of cash, which represents money you will have access to monthly or annually. The first wealth generator is cash flow, which is the money left over from the monthly rent after paying all expenses such as the mortgage, maintenance, management, etc. Think of cash flow as your profit. The next generator is tax benefits. These are things such as depreciation of the property and deduction of any improvements on the property. Also, since you would be a real estate investor, you can deduct business expenses. This could be travel expenses to and from the rental property, the square footage of a home office, cell phone, equipment bought for the purpose of the business such as a computer, printer, etc. These 2 generators are depicted by a cash in hand graphic because it is cash that is readily available at the end of each month or year. Next, we'll look at the piggy bank. The first generator in that category is market appreciation. This is the natural tendency for home prices to rise over time. The next is equity buildup. As a renter pays rent, they pay both interest and principal. The payment on the principal becomes equity. Currently, you see the first 4 generators depicted in green. I want to separate them from the next 2 because the first 4 are normally realized with rentals. The 5th generator is equity capture. This is when you buy a property under the appraised value. The difference becomes equity. For example, if you bought a property for $80,000 and it appraised for $100,000, you would instantly capture $20,000 in equity. You made a good deal. The 6th generator is forced appreciation. This is when you make an improvement to the property that increases the appraised value. For example, if you bought the property for $70,000 and you made $20,000 of improvement and it then appraised for $100,000, you would have a total of $90,000 into the property. But the remaining $10,000 of the appraised value would be instant equity. Congratulations, you just made $10,000 off of improving your property. Also remember that the $20,000 spent fixing up the property is also tax deductible. Although the last 2 generators are possible, you have to be more proactive to obtain them. They're not as common as making money through the first 4 generators. Remember, all the money you're making in the piggy bank is not available to you until you sell the property, or you do a cash out refinance or some other strategy. Now that I've introduced you to the wealth generators associated with rental income, I want to talk to you about the method for the beginner investor called house hacking. House hacking is a term introduced by the creators of the Bigger Pockets Investing Network. I encourage you to check out Bigger Pockets' free podcasts and forums and books they sell covering a myriad of investment scenarios. There are 2 main types of house hacking. The first is where an individual buys a property and lives in one of the rooms and rents the other rooms. This is a great method for someone who is single and does not have a family. With this method, one could quite possibly live for free while the other tenants pay for the mortgage. The second method is where one buys a property as a primary residence and lives in it. Then once they move out, they simply turn the property into a rental property. This method may appeal more to someone who has a family and would not want roommates. So you might be asking yourself, why not just buy a property as an investment property? You could do that, but you would likely pay at least 1% higher in the mortgage interest, and you would have to put down 20%. Whereas if you are buying the property as your primary residence, you get the advantage of getting the best mortgage rate for which you qualify. And you will likely be able to have a down payment closer to the 5% mark, depending. Also, if you are a veteran and wish to use your VA loan, you cannot use a VA loan towards an investment property. They can only be used towards loans for primary residence. Okay, let's go ahead and take a look at this house hacking concept with real numbers. This is a page from D.R. Horton, a national builder, and it is in the Killeen, Texas area next to Fort Hood. Here you can see the house is listed for $196,495 at 1,665 square feet. It's one story, has 4 bedrooms, 2 bathrooms, and a 2-car garage. You can see here that D.R. Horton has estimated that the monthly payment or the monthly mortgage would be $1,115.15. Here on the left-hand side, you see D.R. Horton's mortgage calculation. On the right-hand side, you see the same numbers plugged into the U.S. mortgage calculator. I duplicated this process for 2 reasons. One, so you can see that I use exact numbers that I took from the D.R. Horton calculation. 2, I'm going to go ahead and use U.S. mortgage calculator graphics in the subsequent slides. The annual interest rate, the monthly property tax, monthly home insurance, and the monthly HOA dues were all generated by D.R. Horton's calculation. For this example, I chose the zero down VA loan. This slide depicts several important factors. First, you see interest depicted in orange on the graph in the upper right. Remember, interest is what you are paying the bank for the privilege of receiving a loan. Charging interest is how the bank earns money. The principal you pay as part of your mortgage is depicted in green. The amount you pay in principal becomes equity, held as value within the house. Equity, put simply, is the amount of money you would receive if you were to sell the house. Taxes, insurance, and fees are depicted here in purple. On the left-hand side, you see a pie graph depicting the monthly payments in the month of December 2021. 28% of December's mortgage went to principal, which becomes equity. 37% went to the bank as interest, and 35% went to taxes, insurance, and the HOA. It is important to take notice that the amount paid in the mortgage remains the same from month to month throughout the time the house is financed with a fixed rate loan. This is highlighted in yellow on the table to the right. While the mortgage payment remains the same each month, you'll notice that the amount that goes toward the principal increases each month. Remember, this is the equity that is building up in your piggy bank. With each subsequent month, your equity increases, while the interest that is being paid to the bank continuously decreases. If you are the only occupant in the house, you pay the entire mortgage. While the principal goes to your piggy bank, you pay the taxes, insurance, and interest. If you move out and turn the house into a rental, you still get the principal that flows into your piggy bank. However, you pass the cost of the taxes, insurance, and interest to your tenant in the form of rent. Let's run through the numbers. On the right, you will see the graph from the previous slide. In this example, you will see that the rent listed in red in the upper left is $1,550. Below, we will list the components of the mortgage. We have the principal, which is your equity that goes into the piggy bank. Next is the interest that is paid to the bank. Then there is taxes, insurance, and HOA fee. These 3 components comprise your mortgage payment. Also, as part of the rent, there are maintenance costs and maybe a management cost. When you add all these costs up, you get a total monthly cost to you of $1,400.82. Now subtract the total monthly costs from the rent and you get the profit or the cash flow. In this example, the property is cash flowing $149.18 each month. Remember, the principal goes back into your piggy bank, while you have passed the interest, taxes, and maintenance cost off to your renter. Okay, on the left we see the same monthly numbers, and on the right, we see the numbers expressed annually. Now let's wipe the monthly numbers and concentrate on the annual numbers. Since the renter is paying the interest, taxes, and other associated expenses, we will slide those numbers over to the left. This will leave us with the money made on the right. Let's move the cash flow numbers up under the principal. Remember, we talked about the different wealth generators. Here we see principal and your cash flow. Now let's take a look at market appreciation for the year. Here I'm using Zillow Home Value Index, which will give us the market appreciation for any area in the past year. Appreciation for homes in the Killeen area this past year was 10.8%, so we'll use that number for our calculation. Now to make things simple, we'll multiply the percent of the market appreciation, the 10.8%, by the cost of the house, which was $196,495. When we do the math, the dollar value of the appreciation for the year is $21,221.46. So when you add all our wealth generators up, you will make $27,212.83 in the first year of renting. Additionally, you'll receive tax benefits. Now, the appreciation for the Killeen area this year was awesome, and it gave you a lot of money. Keep in mind, although most places will appreciate, all may not appreciate at this rate. Okay, let's take these numbers and plug them back into the wealth generator diagram in order to assist us in understanding how we are receiving our wealth. The principal and appreciation will go back into our piggy bank, where it is stored until we sell the property or refinance it. The cash flow and the tax benefits are readily available to us. However, I would recommend that you place these savings into an account to use as a reserve in the case that you have an unexpected expense associated with the house. As you can see in this example, 3 of the wealth generators, principal, market appreciation, and cash flow, made $27,212.83, with the added bonus of tax benefits. So, how best can we use the military to build our wealth leveraging real estate? Well, when you come into the military will move you to your new duty station. If you buy a house at your new duty station as your primary residence, you'll likely get the best mortgage rate for which you qualify, and you can usually pay a relatively low down payment. Or in the event that you use a VA loan, you will have no down payment. Once the military decides to move you, you simply turn the residence into a rental property. This fact of military life is one of the key components in using the military to help you build wealth through real estate procurement. Each time you move, the military will pay for it. You don't have to pay to move to your next investment. Once you're at your new duty station, you can repeat the process again and again and again and so on. You can repeat this process throughout your career until you have amassed a respectable number of rental properties. So what is my motivation in assisting you in building wealth? Well, there are several. First, I am a retiree who did not realize this method of building wealth until I was toward the end of my career. I wish I had a mentor to share this knowledge with me. Second, I am now a real estate agent and I can make money working with you at no cost to you. Here's how it works. Agents who assist buyers are called buyer's agents. Buyer's agents get a commission for helping you buy a house. However, the buyer does not pay the commission. The seller pays the commission to both the buyer's agent and the seller's agent through the respective brokers. Here's an example. Let's say the house that you want to buy is being sold for $200,000. And let's say the commission is for 6% of the sale price, split between the seller's agent and the buyer's agent. So you buy the house for $200,000. 3% of the sale price is paid to the seller's agent, which is $6,000. And the other 3%, or $6,000, is paid to the buyer's agent. So how do I benefit? Well, if you use me to locate a competent buyer's agent for you, it allows me to refer you to them, thus allowing me to collect a referral fee from your buyer's agent. Of note, you have to be a licensed real estate agent to receive a referral fee. The referral fee is often around 25% of either the buyer's 3% commission or the seller's commission, depending upon to which agent you were referred. So in this example, I would receive a $1,500 referral fee, which would come out of the buyer agent commission. The agent would gladly pay the referral fee because he or she did not have to work to get your business. Rest assured, no matter to where you locate, I am able to find a competent agent anywhere in the United States and its territories. Additionally, if you use me to locate your agents, I'll always be happy to consult with you about purchasing properties, selling your properties, or rental strategies. I look forward to earning your trust and establishing a long-term partnership with you. Thanks for joining me in this episode. And remember, it's all about securing your financial future by building as many streams of passive income as possible. Learn to work smarter, not harder.